What is top-down analysis? Well, top-down analysis is a technical analysis technique that combines multiple time frames and tools, and we will talk about both the time frames and tools we can use here. And we use multiple time frames and tools to get a comprehensive and a deeper understanding of the market. To simplify, we analyze the high time frame, the medium time frame, and the low time frame in order to look out for different kinds of signals, like, for example, identifying trends and market direction. And this is usually something we do on the higher term time frames. However, identifying trends and market direction can sometimes also be done on the more medium term time frame, but we will talk about that more soon. We also use top-down analysis to find key levels of support and resistance. Let me delete that one. And here, once again, the key levels are often found on the high to medium time frames. Another thing we look out for, and this can be very useful, is that we want to look out for momentum and or momentum divergences. Once again, this is more of a high time frame to medium term time frame things. But what about the shorter time frames? Well, we use the short term time frames to identify precise buy and sell signals. So buy and sell signals are mostly found here on the short time frame, and we can use things like momentum, chart patterns, candlestick patterns in order to find our precise entries. And last but not least, what we also can do here is that we can evaluate the volume and the market orders. So when it comes to volume, we can use things like volume profile or a simple volume indicator. This is mostly done on the shorter, but can also be done on the medium term time frames. But we can also actually analyze the market orders. So we can do some order flow analysis where we look at the buy and sell orders. And if you now think that this sounds complicated, don't worry, because during this course, I will really try my best to simplify these concepts. And by the end of this course, you will hopefully realize that it's not as hard as it might sound right now. So just make sure to stick with me here during the rest of the course. But all right, so now it's time to take a look at time frames. And first of all, what do we mean by time frames? Well, a time frame refers to the time period of the candlesticks on a chart. And some examples of time frames are the daily time frame. This basically means that every candlestick on the chart represents one day. We also have, for example, the 4-hour time frame, meaning that every candlestick is 4 hours. The 1 hour time frame, every candlestick is 1 hour, and so on and so on. And now, real quick, before we continue here, I just want to show you guys how you can change the time frames in TradingView. By the way, if you guys haven't gotten started with TradingView yet, I do have a special link that will be both in the top comment as well as the description of this video that you can use to try out TradingView Premium for free for 30 days, and you can also get a $15 bonus. But now, as you can see, we are currently looking at a Bitcoin chart, and every single candlestick on this chart right now represents one day. If you look up here in the upper left corner, you can see that it says D right here, meaning that we are on the daily time frame. And if you want to change the time frame, you basically click on this button right here. And here you can see that we have tons of different time frames to choose between. So let's say that we want to go to the 1 hour time frame, then we simply click right here. So now we are on the 1 hour time frame, meaning that every candlestick right here represents 1 hour. But now then, when it comes to time frames, different styles of trading use different time frames. So for example, day trading is a style of trading when you buy and sell within the same day. So because of this, day traders usually use time frames from maybe 1 hour all the way down to, for example, 1 minute. And this is usually what we refer to the low time frame. Another type of trading is swing trading, and swing traders can hold positions from a few days up to a few weeks. And the time frames swing traders use are from maybe the daily time frame down to the 1 hour. And this is what we refer to as the medium time frame. we also have, even longer trading and investing types. Long-term investors can hold positions from a few months to a few years. So the time frames long-term investors tend to use ranges from around the monthly time frame to perhaps the daily time frame. And these time frames are referred to as the high time frame. Our goal here with top-down analysis is to, as we have been talking about, combine multiple time frames to get a full and better picture of the market. So another term for this is multi-time frame analysis. But now then, let's take a look at a question that many of you guys might be asking yourself right now. And that is, of course, what are the best time frames to use for our top-down analysis? And first of all, in top-down analysis, we typically use 3 different time frames. So here we need to choose 3 different time frames that not only are good on their own, but they also need to combine into sort of a good package. The time frames needs to work well together. So how do we pick the best time frames? How do we know what time frames to use? Well, for this, at least what I do here is that I aim for a ratio of 4:1 to 8:1 between the time frames. And if this sounds confusing, don't worry, we're gonna talk right now about what I mean. So for example, when we are looking at the daily time frame to 4 hour, what is the ratio here? Well, in one day we have 24 hours, and in 4 hours we of course have 4 hours. So what we do here is that we compare how large is the daily compared to the 4 hour, and we can see that the daily time frame is 6 times larger. Or in other words, we have a ratio of 6:1. So, and as you can see, 6:1 is in the middle here of 4:1 and 8:1. So this right here is a good ratio. So we can, for example, have daily time frame as our high time frame and 4 hour as our medium time frame. But what about the specific time frame combinations? Well, a time frame combination that I use is this one right here. We have the daily time frame, the 4 hour time frame, and the 30-minute time frame. And why does this time frame combination work? Well, as I said, the daily to 4 hour have a ratio of 6:1, and the 4 hour to 30 minutes have a ratio of 8:1. So for example, 4 hours, that's 240 minutes, right? And if you divide this by 30, the zeros here cancels out and we get 8, right? So here we have a 8:1 ratio between the 4 hour and 30-minute time frame. But remember here, what I aim for is a 4:1 to 8:1. So what we also could use here is we can use a 1 hour time frame instead, because this ratio 4 hour to 1 hour has a ratio of 4:1. So this is still a possible combination. So instead of the 30 minutes, we can use the 1 hour instead. But one reason here that I usually prefer the 30-minute is that we will have twice as many candles and we will get a more detailed short-term picture of the market. And many times that can actually be a big benefit. Okay, so now let's take a look at our top-down analysis trading strategy. And this trading strategy consists of 3 simple steps. We're gonna do long-term analysis on, for example, the daily time frame. We're gonna do our medium-term analysis on, for example, the 4 hour time frame. And last but not least, we're gonna do the short-term analysis on, for example, the 30-minute time frame. So next up, we're gonna talk about exactly what we need to look out for here on the daily time frame, 4 hour and 30-minute here, to perform our analysis, and as a result, take trades that are based on a more comprehensive picture, and as a result, get higher probability trades and win more money. But once again, before we do that, I just want to repeat here that we can use alternative time frames. So for example, if you are much of a shorter term trader, let's say that you are a day trader, or you might even consider yourself a scalper, Then another time frame combination here could be the 1 hour, 15 minute and 3 minute time frame. And why does this work? Well, the ratios here are 4:1 and 5:1. So for example, the 1 hour to 15 minutes is 4:1 because 1 hour is 4 times larger than 15 minutes. The 15 minutes to 3 minutes is 5:1 because 15 is 5 times as large as 3 minutes. So the time frames I'm going to use here is 30 minute, 4 hour and daily time frame. But feel free to use other time frames if that suits your own trading style better. Alright, so now to continue watching this course, simply click or tap on the screen right here. I hope I will see you all in the full course very soon, but for now, take care. Ciao, ciao.